G'day guys, Ben Nash from Pivot Wealth here, and today we're talking about ESS employee share scheme tax hacks and mistakes to avoid. Guys, this is the third event in our employer share plan series. So what I'm keen to do today is to really dive deep. In the last couple of sessions, we've been talking about the overview, like the different share plans that are available, how they work, some of the considerations around them. But today, what I'm keen to really focus in on is the tax side of things, the considerations around tax, and ultimately how to end up with more money in your bank account after your ATO donation. So guys, before I jump into the content, please don't rush out and make any life-changing decisions off the back of what we cover. I strongly encourage you to seek out personalized advice before jumping in. You should probably be thinking about doing that anyway. So look, guys, in terms of the challenges with employee share schemes, that, and especially with tax in particular, that if you're not smart about what you do, then you end up blindsided by tax. You suffer this reactive selling, run excessive risk, and face frustration and stress, and ultimately make slower progress and don't truly profit from your plan. Because it's great to have shares on paper and to receive some benefits from your employment, but the trick is when you're actually, like, when do you cash in on this money and help use it as a vehicle to help you live your life? The opportunity, though, on the flip side of that, is that you can be smart and get a clear tax plan, have an optimized sell strategy in place, clarity on where you're headed and what your share plan means for your wealth journey and ability to get ahead, and be taking smart risk. And look, I think with this stuff that there's a lot of opinions, points of view, especially like virtual water cooler chat or actual water cooler chat, people that actually rub shoulders with human beings these days. And everyone seems to have an opinion of what the best thing to do is, or what you should be doing to be the smartest with your money. But there is no one right way. So there's no one set of steps that every person can take that's going to get the most out of what they've got or to lead them to financial success, because the right moves for each one of you, it really depends on you. It depends on where you're at now. It depends on what's important to you and how your situation is going to change over time. So today, instead of me sitting here saying, oh, you're going to follow these 17 steps to become a multimillionaire, instead, what I'm going to help you understand is the key things that you need to be aware of, questions to ask and answer to make sure that you make the right decisions for you. Because ultimately, what the aim that we're going for is to accelerate your progress to your financial potential and to actually profit from your employer share plan. So the types of share plans that are out there, I'll run through the three, and then I'm going to get into the tax and considerations around that. Employee share purchase plans. So as I covered in the last webinar in this series in particular, and feel free to go and check that out if you haven't seen it already. But essentially, you're giving up after-tax pay. You have some shares that are offered as a discount. Essentially gives you free money. It's either offered as a discount or they sometimes give you matching. And I'm going to talk a little bit about structures in a second, but essentially give you a bunch of free money if you're smart with what you do. And I'll give you some of the tactics around that. But there is a cash flow consideration for you to be aware of. The rules when it comes to employee share plans is that you've got this participation period, you put in after-tax salary, and then after a period of time, your shares are released, and there's some sort of generally discount or share matching that's applied. So the discount might be a discount to the current market price or a discount to some price that happened in the participation period. And the matching option is where they'll give you X dollars worth of shares or X number of shares. And then after a period of time, you'll get an equivalent number generally as well. Each of them are a little bit different and worth separating out, especially when we're talking about the tax side of things. The different ones that they have is the discount on the start end price, low point, share matching, and share matching with a lockup period where the shares get released over time. And again, I dove deep onto these in the last session that we did, but I wanted to call them out because it does make a difference with the tax considerations. So how the tax works with employee share purchase plans in particular, and I'll get into the other ESS setups in a sec, but essentially you're putting in your after-tax pay. And how it commonly works is that you can contribute up to a certain dollar value or a certain percentage of your salary. So let's just say it might be $5,000, or maybe let's use $10,000 to use round numbers within any given participation period. Because the money is that $10,000 is coming out of your after-tax pay, tax has already been paid on the on your employee share plan. Now, most of these plans, there are some rules where there's like some employees can give you up to like $1,000 worth of shares where you don't have to put in after-tax pay, or you can salary sacrifice. That's specifically not what I'm talking about in this case. But what I'm talking about is the majority of share plans where you earn an income, you pay tax on that income, and then you use that money to participate in this employer share plan. Now, going back to that example, because the $10,000 has been already taxed as income, the ATO is kind enough to not double dip and tax you again on that money when you receive it as shares. But instead, what you do get taxed on from the ATO is any discount that you receive, or any discount that you receive on your shares if you're in a discount scheme, or if you're in a share matching scheme, you essentially get free shares. So it's at the price that you pay is zero. So your discount is the entire value of the match shares, or the shares that are given to you as part of that plan. So if say you're in a discount plan and your discount is 15%, then on the $10,000 example, you would have received a $1,500 discount, and therefore that $1,500 is essentially taxed as assessable income, the same as it would be for your ordinary salary income. It's like your employer gave you a bonus of $1,500, or you got a commission payment of $1,500. So the tax gets taken out at your marginal tax rate, which if your income is above $45,000 is 34.5% a year. If you're above $120,000, that's 39% a year. And if you're above $180,000 total income, then your discount is 47, like your tax rate rather is 47.5%. So because that amount, when you receive the discount, or when the ATO does their tax calculations, they know the headline number. It's like you received a cash bonus, but the difference with receiving a cash bonus or a commission payment compared to an employee share plan, and it's the same with some of the other plans as well, is that there's no withholding tax on that money. It's not like when you receive a cash bonus that your employer deducts a certain amount of tax, which sort of generally pretty much balances out with the amount of tax that you should be paying on that money. Instead, with an employee with these discounts, they just give you the shares, and then you accrue a tax liability, to use a bit of jargon, but you essentially, when the shares are received, you immediately owe the tax office money when you do come to do your tax return, but you haven't withheld any tax. So the tax seems like it's bigger because there's no withholding. The thing is with that it means that you've got a plan for it, and I'm going to get into the detail of how you do that. Now, with these plans, with the discount plans, a little bit more so than the matching plans, but it's essentially free money, because you immediately get, with the discount plans, you get an immediate discount on the shares. And if you sold them immediately on that day, you will benefit in the amount that you put in, as well as the difference between the discounted price that you receive the shares at and the market price at that time. So if you sell immediately upon shares being received, you're essentially guaranteed to get the money that you put in back plus the extra on top. So it's essentially like free money. What that means is that it's generally makes sense to take as much free money as possible. If you get offered free money, it's a good thing. So you want to take free money and generally participate up to the maximum amount possible. Worth noting that you do have to deal with the cash flow side of things. So you do have to actually fund your participation in that plan. So there can be consideration around that. So something to be aware of. But if you've got some if you're getting free money, then there's immediate benefit. You should be aware, though, that just going back to that if you don't sell your shares immediately, then it can end up being that if the share price goes down, then you can end up owing tax on money, or your total amount of shares can be worth less than the money that you put in. So there is a bit of a risk there. So when we think about ESPP tactics, employee share purchase plan tactics, you want to firstly be aware of whether there's matching or discount that applies on your shares, because that's going to dictate the tax outcomes. Be aware that there is that tax on release of the money, and know what your exit plan is. So be aware, how it fits in with your broader strategy, and make sure that you're clear on what that is. Because if you don't have a clear exit plan, then you're going to be caught in that reactive selling trap. The next one that I want to talk about is restricted stock unit plans, where essentially you're with an RSU plan, or RSUs, restricted stock unit plans, that your shares are granted to you essentially for free, and then they vest over time. The amount that you receive when your shares vest or become available to sell, they're taxable income to you, regardless of whether you sell the shares or don't sell the shares. It doesn't make any difference. And some people think that there's no tax considerations until they ultimately sell the shares, but that's unfortunately not the case. It means that you need to be strategic. The other thing is that when the shares vest or become available to you, that capital gains then start accruing, and then you need to consider and pay capital gains tax when you ultimately sell the shares, so long as there's a gain. Also, capital losses accrue as well if the shares go down. So how the RSU tax works is that there's no tax that applies on the grant of shares. So when someone gives you the shares, generally because they're not available to you, there's generally no tax that applies on that grant. When the shares vest or become available to you, the total amount that becomes available to you is generally taxed as income, because the whole amount that you've essentially received these shares for free. You've received a discount equivalent to the current market value. And because that's a benefit that you've received due to your employment, that the ATO taxes that like ordinary income. Again, I'm sort of addressing these in a different order, but there's no withholding tax. So that means that if you're in the 34, 39, 47% tax brackets, that if you get $10,000 worth of shares, you're going to owe somewhere between $3,400 and $4,700 on that money. So it's a chunk of change, especially because there's no withholding. So when people, especially when you're early on in your in an RSU plan, that you can start getting hammered by these tax bills. And if you aren't aware of the tax complications, you wonder what the hell's going on. But it's because that entire amount is considered income, and that all gets reported back to the ATO automatically these days as well through their matching system. Now, when the shares become available to you, say you get $10,000 worth of shares that vest or become available to you, that then $10,000, because you're taxed up to that $10,000 as income, that then becomes your cost base for the shares. So if the value is $10,000 when they become available to you, and then you hold on to the shares for a bit and you end up selling them at some point, say you sell them for $15,000 in the future, then you've got a cost base of $10,000 and the gain is $5,000 on top, which is taxable as per capital gains tax rules. Now, one thing to just be quite mindful of when it comes to restricted stock units or RSUs is that especially like with what we're seeing in the markets at the moment, when the markets are declining, or when the share price of the company that you're receiving the shares in is declining, that because you pay tax on that $10,000, if the value of your shares then halves, it can mean that you're caught short. So you're the one that you have to pay tax at the $10,000, but then if you sell the shares, you might only sell them for $5,000. Means that you're the one holding all the market risk with that, but you are committed to paying the tax on that money. So you can end up in a slightly challenging situation, especially if you're not aware of the tax issues and then smart with what you do or strategic with what you do. So that's a key consideration. In terms of the tactics around your RSUs, it's essentially, sell some or none. They do become golden handcuffs, and I'll talk a little bit about real and sort of literal and not so literal golden handcuffs in a sec, but you want to have a plan around your tax. Now, with an ESOP, the employee share options plan. That's generally pretty common in startup companies that aren't yet listed on the stock exchange, where you are given an option to buy a share at a set price at some point in the future. And they're gifted, they vest or become available to you. So then you can vest and it becomes available to exercise. You can choose to exercise or you can not exercise, but they do need to be exercised if you want to convert them into shares. Just got a question here from Ben, who asks about whether you get the tax back in the following year. So, and I think that the question is really, if the shares vest at, say that you, going back to that example, at $10,000 and then the share price declines, you have to pay the tax. Do you receive any tax benefit in that? Unfortunately, no, from an income perspective. But because if, say the shares vest at $10,000, you owe tax as if you burn $10,000 of income, and then you sell the shares for $5,000 because you need to say cover your tax bill. You would accumulate a capital loss on those shares. So the difference between the cost base, which turns to $10,000 once the shares are released to you, and then the $5,000 that you sold them for, that becomes a capital loss, which is then offset against future capital gains. But importantly, it doesn't offset future income tax that you receive on your share vesting. So if you do that, you suffer a big loss, you've got this massive accrued capital gain, and then you could get hundreds of thousands of dollars of RSU income or discount income. Then you don't, unfortunately, that just sits there until you have other capital gains to offset the money against. So I hope that helps, Ben. ESOP tax, essentially there is no tax on the grant or the vest, but the tax applies when you exercise the option to then purchase a share. So when you're exercising the option, because say you might have an option to buy shares for $1 and the share price is $10, then again, you're essentially getting a $9 discount rather. So the difference between how much you pay, you're welcome, Ben, the difference between how much you pay and how much the shares are worth is a discount that you've received because of your employment and therefore is taxed as income. So you guys are probably seeing a little bit of a trend here when it comes to how the ATO assess and consider what is actually income for you. So what that means is that if you're exercising shares, you can accrue an income tax liability that then needs to be dealt with in the future. Now, where that's particularly important is if the shares that you've got, if the company that you've got shares in is not listed on the stock exchange, because you might be exercising shares and creating a tax liability for yourself, but without being able to actually sell those shares to create cash flow to then pay your tax bill. So again, you want to be really considered with how you do this. But there is one sort of slight exception to this, which is an important one to be aware of, and it's a tax carve out that the ATO has in place in Australia for early stage startup companies. And essentially, if you have an employee share options plan in a company that qualifies for the early stage startup concessions, what that means is that there is no tax applied on the grant, vest, or exercise of your options, and that the tax only applies when you actually sell your shares after you've converted the options to shares, then ultimately sell the shares. The other thing is that the cost base that that the ATO considers for that is the amount that you put in as the exercise price. And one of the conditions for getting the early stage startup concessions is that the value of the company needs to be below a certain level. It's around $6 million in the ATO, and the ATO have some really, it gets quite complicated, but they have some really clearly defined valuation methodologies for that. The reason that I bring that up is because a lot of times with an ESOP where there is early stage startup concessions in place, that the exercise price is very close to zero. So essentially all of the benefit that you get is going to be pretty much free money, and free except you owe the ATO money and it's taxed as income essentially. So the cost base ends up being the exercise price, and the capital gains tax date is the date that the shares become available to you. So essentially, the date that the options are initially granted. So if you get an options tranche 3 years ago, and then it vests over 3 years or 5 years or whatever that time period is, and then you sell it today or you sell it a year from now, that the ATO considers it like you purchased the shares when the initial grant was given to you. So it could be years in the past. Why that's important is because with capital gains tax in Australia, when you've held an investment for longer than 12 months, that you get a 50% discount on the capital gains tax on the assessable gain. So essentially you could sell you get $1 million worth of shares. If it's the capital gain would be $1 million, but if you're getting the long-term capital gains tax discount, then the gain's only $500,000. You're paying tax on $500,000 less. It's hundreds of thousands of dollars of tax that you don't have to pay. And I'm seeing a lot of people work with people that have worked for the same company, have similar values of shares, but the capital gains tax can be significantly different if they don't have their strategy right there. So that's the early stage startup concessions. The tactics around that there is sometimes limited control. So it really depends on the ESOP plan and the rules of that plan. They all can be a little bit different in terms of how you, what you can actually do. Can you exercise before the company lists? Can you transfer the shares to another person? So you have to check out the rules, get some good support. Normally those ESOPs can be quite lucrative, so it probably pays for itself to get some good advice at the start, especially if your company's on a good path. The exercise point drives tax, and you need to fund the purchase though. So just be strategic around that, and you want to be smart with your planning. Got a question here from Richard. Richard says, a phantom stock's the same as RSU. If you were to receive a lump sum cash payout, is it possible to have an option to have it as a staggered payment to possibly cross tax years and maybe even lessen the tax you pay? Richard, I think there's two questions there. I think in terms of paying out, you could consider that as a payout, but it's also, you could consider it for someone that has a bunch of shares that wants to, or a bunch of options that wants to exercise them and exit, that if you spread that over multiple tax years, you're absolutely correct that you would pay less tax because it's generally falling more into more years. Be aware though that if your salary income is above $180,000, you're already on the top marginal tax rate. So it's not going to be any less by spreading it over multiple years if you're well entrenched into that top marginal tax bracket. But if you're on anything below $180,000, then you are going to receive a benefit from spreading your payments over multiple tax years. And phantom stocks, I'd say that phantom stocks are probably the same as an ESOP, or probably more similar to an ESOP or employee share options plan than an RSU plan, because normally with RSUs, it's like you're getting shares that are, and they're normally for listed companies, and you're entitled to dividends and things on those shares as well. Hope that helps, Richard. So yeah, obviously, along with the theme of this talk, that really tax planning is key with this stuff, and I want to dive into that to help you understand how you can go about doing that. Essentially, the tax inputs when you go to thinking about a tax plan are what I've got up here. So the drivers of your tax is the tax that you've got from the last financial year. So how much do you owe for the financial year that's ended on 30 June just gone, especially that you don't have to submit your tax return until May. So for some people, if they're not early lodgers, then you may owe tax from the previous year. Then you've got, if you think about right now, today we're in February. So if you work for a company and you've been participating in an ESPP or ESOP or RSU plan, then you might have received some shares and some benefits between the 1st of July last year and today, which means that there would be some accrued tax for your financial year to date. And then if you are on a tax installment plan, a quarterly tax payment plan with the ATO, then that offsets the amount of tax that you pay. Because normally how that works is that if you keep getting tax bills more than 2 years in a row, the ATO starts to calculate and say, hey, we think you're going to need to get a tax bill of around your $40,000. So we're going to just bill you $10,000 per quarter. So if you have been paying tax installments, that reduces your tax liability, and then the accrued tax adds to your tax liability, as well as anything. If you want to be planning with your tax, then moving forward, each time ESPP, ESOP, RSUs vest or become available to you or get released or whatever it is, depending on the plan, then there is tax that applies that should be factored into your tax plan. What you want to be doing is aiming for break even. So if I today had, a tax bill from the last financial year that had just finished, I'd vested a few shares between the 1st of July and today, and I owe a bit of tax for last year, for this current year, then what generally is a prudent approach to things is that you've got enough cash in the bank account that you can pay your tax bills when they come due. Because if you don't, and I think I've actually got this on a previous slide, but if you don't, then your tax plan really is golden handcuffs, because it means you can't walk away from your job without walking away with a massive ATO debt, and it's going to be a real handbrake on your confidence in being able to do that. Now, people generally like their job. That's why you take jobs most of the time. So I'm not saying you would walk away, but just from a peace of mind, financial well-being perspective, knowing that you've at least got the amount that you owe to the ATO covered should give you a lot of confidence and a lot of flexibility in what you do. You want to then map this out. So once you know all of those inputs, what tax do I owe from last year? What tax do I owe from this year? What tax do I have paid that reduces my tax? Then lay it all out. Don't overextend. And this is what I see a lot of people do, that they've got a lot of money on paper or shares on paper. They don't think about the tax that they owe to the ATO. And then ultimately, they'll bat up and buy the house and have a much bigger mortgage than what they would if they had more clarity on what they were doing. And you get overextended, and then it turns into a huge stress. And normally, especially when your employee share plan's building up, your company's doing well, the money's building up, you should be aiming to not put yourself under pressure. You want to fit in those tax payments with your plan. So make sure that you got the cash flow side of things covered when your tax is due. And in the meantime, you want to put that money to work. If you got an offset account or whatever, different options, get the money actually working hard for you. So it's not just sitting there doing absolutely nothing in a bank account. I'm going to talk through the process on how to plan, but I just got a question here from Katie. Katie says, the company I work for is publicly traded. I was granted options when I first joined pre-IPO, and still have some of those options that I need to exercise. The options were granted in 2016. In Australia, when I exercise, is considered to be long-term capital gains tax category, or do I need to hold them for 12 months post-exercise? Katie, it really depends on whether your company has the early stage startup concessions or not, and that's normally in the ESOP contract. So those documents are generally pretty dense, but if you look through the ESOP contract, then that should give you an indication. There should be a little clause in there that talks about that. And normally if you had options that were granted in 2016 and they did qualify for the early stage startup concessions, then they would consider to have been acquired by you in 2016. If you didn't, then it depends on your exercise, the timing of your exercise, and when you actually receive the shares. So, and whether you can whether you can exercise and actually have the shares available to you as well. So look into the details of the plan there, Katie, and that should give you a bit of an indication as a starting point. So in terms of how you actually go about planning around your share plan, planning around your tax plan as well, and then wrapping that into your personal, actual wealth creation plan, key steps to go through, focus on what's important, clarify all the moving parts that are going to impact your plan, strategy, map out, buy investment properties, sell shares, keep shares, do nothing, whatever. And then you want to put it all into an action plan, try to automate as much as you can, and then refine and execute over time. If you do that, you're going to be on top of your tax, maximizing the opportunities that are in front of you. And you should have a lot of peace of mind knowing that you've covered all of your bases there. I just want to quickly finish with some of the mistakes that you should look out for and things to avoid. The lack of clarity on your real position is one of them. Making choices from just your pre-tax position. So that's what I was touching on before, that you're actually making decisions thinking that you've got all the shares on paper when you really do owe money back to the ATO. The real golden handcuffs, as I mentioned, that if you don't have your tax covered, you're essentially locked in with your employer, and you can't walk away even if you did want to, or your personal situation changes or whatever. And another thing that I see, and I see this a lot, is people that are getting support from people that aren't experts in employee share schemes. Could be financial advisors, could be mortgage brokers, could be accountants. And these people don't understand the ins and outs of these plans. And then they're getting conflicting advice and telling them the wrong things in some cases. And it means that you're the one that ends up suffering as a result of that. With mortgage brokers, for example, some of them understand employee share schemes, and then they can help you get use banks that actually consider that as income. Now, you've got to be careful with that stuff, but for the right person in the right situation, that can make sense. So you want to have the experts in your corner with this stuff. General stuff when it comes to ESS mistakes is that thinking that risers will keep going forever. Last month has taught us that that's not the case, but you don't want to be banking on that as your strategy. It's going to be a stressful ride. Delaying action, you're missing opportunities. You know, for you guys, if you want to set up an income from your investments of $5,000 or $10,000 or $20,000 a month, you need to save X dollars today. If you wait a month, a year, 5 years, it's just X plus, 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 plus. So the sooner you make it happen, the easier it's going to be for you. Sometimes you'll choose to do nothing, but just make sure it's a choice and not just an action, because life has gotten in the way. And then look, figuring this all out on your own, there's a lot of moving parts when it comes to employee share plans. So you want to make sure that you're nailing it and you've got some good support around you. It is going to pay for itself many, many times over. If you've never used that sort of advice or support before, then just ask some questions, do a bit of research and see what the possibilities are, because you'll probably realize quite quickly that there's a ton of money to be unlocked by getting the right support. So guys, look, I hope you found that helpful. There's a fair bit there, but also a lot of opportunity. So I hope it's helped you see some of that. Guys, this is the sort of stuff that we help people with. So if we can help, very happy to have a conversation. What we do is this initial 10-minute ESS opportunities chat where it costs you nothing. We can have a quick chat, see if we can help. If we think we can talk about how. If we think we can't, then we can point you in the right direction. So you're very welcome to get around that. We will send a note over with the link to book that session off the back of today, or you can hit us up through that link there, which is bit.ly/ESS pivot. Guys, hope you found this helpful. We've got our last session in this series coming up next week. If you're not already around that, check it out on Eventbrite.